Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Friday afternoon, welcome to the COB. I'm Nadine Blaney, and as always, a pleasure to be with you. Look, it wasn't a very fun-filled day in terms of equity index performance. We've got the S&P ASX 200 off by 1.6%, CIBO Australia index on your screen there, also really suffering today. Earlier on, we did have the U.S. futures in positive territory. I will say that the NASDAQ E-minis have taken a negative turn yet again. Look, if misery loves company, we've got it around the region. The COB is off by 3.7%. The mainland Chinese market, so the composite, is down by 2%, pretty much. And the Hang Seng is off by 2% as well. So that NVIDIA enthusiasm didn't last very long, did it, on Wall Street, with the NASDAQ closing at its lowest level since September the 11th. Look, it's just concern over the AI spend, whether or not AI is in a bubble. But I had a chat with John Blanks, who joined me from Zacks Investment Research earlier today. Look, he said that it's just a reflection of reality, that share prices need to come down to something that reflects what's actually going on in the U.S. economy. He reckons we could see between 20 and even 30% pullback in terms of U.S. equities. I spoke with Heath Moss today from HLM Investments. He too reckons that we're in for a more steeper pullback. But out of volatility comes opportunity, of course, as well. And if you go to the website, ausbiz.com.au, there's a number of interviews up there that really highlight the fact that you can find some good opportunities when we see markets pulling back. I mean, plenty of these companies, let's be honest, have been trading at eye-watering valuations. Good chat with Joel Fleming from Yarra Capital Management today. He said that nothing has changed in terms of the small micro-cap story. The turnaround and the opportunities are still happening, and perhaps you'd want to get into some of the stocks he mentioned. Again, if you're listening to our podcast, we love you doing so, but we'd love it if you could visit our website as well, ausbiz.com.au. And hey, while I've got you, if you do listen to the podcast and you'd like to leave a review for us, we'd love it if it's a positive one. Of course, all these reviews really do help us grow our audience, which helps us bring you this content free. So look, today, stock sell-off. The week of the stock sell-off was the big talking point. I've got Henry Jennings from Markets Today coming up. We'll chat about that one. Also, big concerns about the cuts. Interest rate cuts. Are they coming? Are they not coming? Will the Fed cut? And the probability, it seems to, in terms of market pricing, is being wound back. And iron soar, so really steep falls for the likes of BHP and Rio Tinto. We've also had reports, and this is reports I will continue to say until it is confirmed. And by the way, BHP does not comment on this kind of report being out there, but we've learned that sources have told Reuters that China has expanded its BHP iron ore ban to new products as its contract renegotiations will really drag. So that has seen the share price of BHP do some pretty heavy damage to this local market. Let's look at that, actually, can we? We've got BHP coming under big pressure, Rio, in fact, right across the materials complex. But look at Fortescue, down by 5.7%. Minres off by 4%. Retailers, we heard from a few of them at AGMs today. Lovisa being one, Accent being another. And look how they've been punished on market. Healthcare, CSL, a bit of a bright light, I suppose you could say, up by about 0.25% to $179.18. And let's take a look at some of the corporate stories that have also dictated what's going on. And that was the Federal Treasurer Jim Chalmers blocking that U.S. takeover bid for Maine Pharma, saying it's contrary to the national interest. And the bidding war for Webjet heating up. BGH Capital increasing its takeover bid to 91 cents per share. Lovisa was the top loser after sales growth missed expectations, and Accent Group hit a 2020 low on its dour earnings forecast. And we heard that there were tears at the AGM coming from Wisetech billionaire exec chair Richard White, saying, look, they want to get the corporate governance there back on track. We just heard from Rachel Waterhouse from the Australian Shareholders Association. She was there, and she said, look, the passion is palpable but still some really big concerns over governance and remuneration. Of course, they got the strike against. Star Entertainment has jumped on a regulatory nod for Bally's investment, and Reese still expects soft activity in the US and ANZ. It was the stock of the day. I'll get you some analysis in just a tick. But a very warm welcome to Henry Jennings, who's joining us from Marcus today. Henry, we meet again. It's amazing how these things happen.
It is. Hi, Nadine, and we do meet again.
Yeah. Look, good to have you here with us.
Sure.
I've got a glass of wine on this Friday. I think we need one as investors because it was a pretty painful week. But there's another way to look at it as well, isn't there? That there are perhaps some stocks looking better value. Do you see the glass half full or half empty?
Unfortunately, well, you can fill the glass back up. I guess it is Black Friday today, Black Friday sale day, very much in the market. November's shaping up as a pretty horrible time. Looking like around about 5% down so far and 2.5% down for the week. So it has been pretty horrible today, especially in the resource sector, which I think someone just decided to knock 10% pretty much off everything. It's one of those David Jones, everything must go kind of sales at the moment. And I don't know what's worse, watching the resource sector melt down or watching the England team bat at the moment. So it's pretty much line ball there. The only saving grace, I guess, at the moment in our market, which could have been a lot worse and maybe a lot worse by the time we close, is CBA, which is actually slightly up for the day, and CSL as well. If we had CBA down, 1 or 2%, that would have knocked another sort of 30, 40 points off the index, and we'd be really struggling. But we certainly have been struggling. So not very nice. I think you're wise, Nadine, to take refuge in a glass of red, and I will probably be joining you later this evening in a similar vein.
Sometimes my decisions are questionable, Henry, as we know, but let's roll with it. So, what about the resources space? I mean, I get that we've got questions about China buying that lower quality ore from BHP, but sure. I think to Juliette's point, it seemed a bit outsized, the selling today, don't you think?
Yeah, I think it is. I think there's a bit of panic going on, maybe a little bit of leverage unwinding, a little bit of baby being thrown out with the bathwater. I guess, it's one sector, as a whole that has held up relatively well. I say relatively well, it's still been bashed, but it has been a sort of a port in a storm. We've seen the lithium space being a port in a storm in the last few weeks. We've seen the gold miners, they come and they go, but generally have been relatively okay. And the bullion price is still very, very good for Australian dollar gold. So there's nothing wrong with the underlying commodity there. But maybe, the whole, it is a bit of a derivative to some extent of the AI boom as well, with the energy story, with the critical metals, with the rare earths, all playing into that. So maybe the market has just decided, you know what, let's just get out. Let's book square. Let's, it's Christmas. Christmas parties are starting to ratchet up, and we just don't need the hassle. So you get the feeling that the towel has been thrown into the corner by some of the investors today, especially in that resource sector, and the market is looking pretty nasty, I have to say.
So what about the retailers? I mean, Lovisa and Accent Group absolutely punished today. Now I know that their updates weren't fantastic. We know, that's just a fact, right? But
yeah.
It seems as if, again, this is investors sort of just saying enough and moving on.
Yeah, very much so. I mean, these are not the kind of times that you want to bring out bad news. This is not the kind of market that will go, we'll look at it. Maybe it's a second half story. Maybe, things will get better. This is not that kind of market. This is the kind of market where, you slip up and you're going to be punished. They're going to kick you when you're down, and it really is going to take no prisoners. And we've seen that today in some stocks. We've seen a bit of a flight to safety. In others, as I say, CBA, CSL holding up relatively well, considering the red wedding scenario that we got the rest of the market. So, retail is obviously at the forefront of the economic sort of theory out there, and that's probably the wrong word, but certainly at the forefront of the economic environment, and it probably feels the pain far quicker, I guess, than others feel the pain. Sometimes it takes a little longer for some of the industrials to see that pain, but retail, it's pretty instant. If people are cutting back and people are wary and people are uncertain about the future and cautious, it shows up pretty quickly in retail numbers. And I think we've seen that today with not only Lovisa, which you would think is a little bit immune to some extent, bearing in mind its sort of its market positioning is not really. It's not, it's not it's not Louis Vuitton, and it's not Tiffany's.
I love how you're trying to not offend anyone, being me wearing my cheap earrings, but yeah, I see what you're saying. However, I can't help thinking every time I go into Lovisa, it feels like everything's on sale. Now that might be their strategy, but I mean this is low ticket price stuff that's then reduced further. I mean. Were you a big believer in the Lovisa story? Has that been tested for you?
Not. I mean, there are times. There's always a price, I guess, when you are a believer in these stories. But I think that was a while ago, and it may come back down to that kind of price. I must admit, Nadine, I don't go into Lovisa stores that often. I haven't got kids in that age range anymore. But the margins that these guys have are quite extraordinary. Let's face it. So. If you're going in there and they're trying to entice you with 10% off or whatever because it's a Black Friday or Cyber Monday or whatever kind of deal, or a Taylor Swift must get your jewellery kind of deal, then they're still getting pretty good margins. And I'd imagine that they're trying to upsell you somewhere along the line with something. As I say, I'm not really that familiar with shopping at Lovisa, but they have got those margins, so they have got that cushion. But maybe people just are cutting back at the moment. Maybe they're saving themselves for Christmas and what Santa brings under the tree. But they are the first to feel any economic pain, and I don't really think the economy's in that bad a place in Australia, and we've seen that in America. It's in not that bad a place there either. But at the moment, valuations got ahead of themselves, and there is a smell of panic in the air, I have to say, a smell of desperation, the get me out kind of trades at any price, which can cascade and can accelerate. And we've seen with Nvidia how that can change in a heartbeat. Last night, 1,000-point range in the Dow, which we haven't seen for a while. So interesting times, Nadine.
Pretty wild. Look, when you are looking at this market, I've had a couple conversations today with people saying, like, don't rule out 20% down. Does that sound, I mean, you've got years of experience. Like, that's not out of the realm of possibility, is it?
It's not out of the realm of possibility. The problem that we've got at the moment is Nvidia and the big seven stocks are such a dominant part of the US market. And if they re-rate, which is quite possible, they will drag down the US market. And of course, they will drag down our market from a sentiment point of view. So that is the danger, as they do re-rate. And when you look at the Nvidia numbers, they were cracking. They were great. The problem becomes, if Nvidia is selling so much stuff, then who's financing all this stuff? And are they getting a return on investment? And that means that the other companies that are buying all the stuff, then you call into question the valuations. And if they're not selling all that much stuff, which is also dangerous because Nvidia is the #1 company in the world. So you can't really win in this scenario. And I think ultimately we are going to see a rebasing of expectations. I'm not sure, even if the Fed was to cut in December, that would be enough to really help things. I mean, that's one of the reasons why we went to 100% cash in our US pretty much focused ETF, the MT portfolio that we have, because we were concerned about these valuations. We were concerned about the bubble and happy to sit on the sidelines. That has made us squeamish from time to time in the last few weeks because we get these short covering bounces, but generally you just get this sinking feeling. And it's just, you wake up every morning with Bloomberg and you look at it and you go, what's happened now? Is it up 2%? Is it down 2%? And I think the path of least resistance at the moment is the downside rather than the upside. Even if we get a small bounce tonight, it's going to be a nervous wait over the weekend, see what happens over the weekend, and then heading into next week as well.
Got it. All right, Henry, thanks for joining us today. I hope you have a great weekend. We'll speak soon.
And you. Thanks, Nadine.
Stock of the day was Reese, held its AGM today. Let's get a view from our experts, Luke Winchester from Merriweather Capital and Claude Walker from A Rich Life.
I'm not going to get into some company that's like just borrowing money for the sake of it, and they already borrowed heaps to make a bad acquisition. Like, this is not the capital allocation I want with my capital. So no way, I would not buy it, I would sell it. And look, mate, it could come back one day. It's got a very good distribution network in Australia, but nah, not now.
I agree with that. I think it's a sell as well. And I think like we've seen this with a few stocks on the ASX. CSL's obviously getting the headlines, and it hasn't been as bad as Reece, but like rewind a few years ago and everyone wanted to pick on Pro Medicus, Wisetech, whatever as being too expensive. To me, the bubble in expensive stocks on the ASX was these compounders where everyone just went, you know, this business is executed for 15, 20 years. And I just went and checked. Reece was trading over 50 times earnings a few years ago. That is just an absurd price to pay for this type of business. Like, at best, you were going to get high single-digit, low double-digit EPS growth. And just the maths on making 50 times earnings work just doesn't work.
Thinking about your pre-Christmas shopping? What if you could buy some stonks on sale? Our final virtual event for the year is Cyber Monday. Join expert analysts live as they share their picks of undervalued equities.
We're looking at between 400 and 500% upside.
It is going to rally away very, very soon.
Beat the Christmas rush. Register now for Cyber Monday at ausbiz.co/cyber.
I hope you can join us for that online virtual event. I'm looking forward to it myself. Okay, so look, it was a bad day on market, but there were some leaders, and there were more in positive territory by the end of the session than we started out with. So around 10:30, I think there was only 13 stocks making forward moves, but by the end of the day, Catapult, GQG, Wisetech in the wake of its AGM, Reece. So my guests didn't have a lot of love for Reece, but share price reaction there on screen today. Charter Hall and Auckland International, actually one of the best performers today. Those companies that did drag though, and they were pretty big, Lovisa, Iluka, Hyperion X, Catalyst, Paladin, and SiteMinder as well. So some growth names in there. Look, we will take a look at the small cap. We already said why. Star Entertainment is higher. Lumos Diagnostics, Tyvan as well is up by about 12%. It's actually had a good week, and IKE GPS. The laggards in the small end of the market, Main Farm after the Treasurer stopped that takeover by that US firm Cosette, and a lot of those in the resources space. It was a terrible day for materials sector. Look, when we take a look at what's coming up, we've got global PMIs and we have US consumer confidence data as well. Now, when it comes to next week, we get US retail sales. So the data flow will pick up from the US after that government shutdown. PPI and home prices. Locally, we get inflation for the month of October. Headline inflation, by the way, could slow down. We'll see. RBNZ rate decision coming through on Wednesday. We're expecting to see a 25 basis point cut there. And on Wednesday, we get the US Beige Book. So the Beige Book gives you economic insights from all the different Fed regions. Here's not a pretty picture to leave you with today. 9 out of the 11 sectors were lower, along with the S&P ASX 200 index. The last 5 days, we're told consumer staples was the best performing sector. No big surprise, it's got a bit of a defensive quality to it. We've got the Australian Volatility Index up by more than 21%. We've got the S&P ASX 200 finishing the day lower by 1.6%. Futures in the US are now mildly positive, so that's been a real changing story throughout the day today. So I wouldn't read, honestly, too much into it at this stage of the game. We've got to see what comes to fruition. We've got the Nikkei extending its weekly slide. We've got tech shares there tracking those declines on Wall Street. So it's a big session coming up. We'll recap it all for you first thing Monday morning when we're live at 9:45. In the meantime, I really hope you catch up with some of the great quality content on our website, ausbiz.com.au over the weekend. Have a happy one. Have a safe one.